Hey everyone, hope you all are doing well. So in today's video, we are going to dive deep into how gold has performed in comparison to the stock market. Does it make any sense to incorporate gold in one's portfolio? And if it does, then what would be the best way to invest in gold? In case you are new here, then do consider supporting this channel by smashing that subscribe button. So we as Indians love to buy gold. This shiny commodity has had significance in our lives since centuries. Traditionally, people used to buy gold so that they can use it in case of financial uncertainties. Well, it did make sense as well because gold was and is still yet considered a store of value. Specifically, when the equity markets become volatile and they crash due to some macroeconomic headwind, then gold becomes the go-to investment avenue for many investors. For example, when the COVID pandemic hit us, then Nifty 50 saw a correction of close to 34%. If you were to observe the price of gold post this correction, then you would see a significant uptrend. Likewise, when the housing market crash had happened in 2008, then Nifty 50 had corrected by close to 56%. Post this correction, you can see how the gold prices have skyrocketed to reach a new high. There's a very simple reason for this. The investors lose the confidence to pour in any additional capital in the equity market, and due to gold's feature of being a store of value, investors see gold as an alternative to park their money. This increased demand for gold leads to a hike in gold's price. Now, one question should arise in your mind. If gold's returns are so good and it performs really well during economic uncertainties, then why not just invest in gold instead of the equity market? Well, gold does perform well during economic catastrophes, but when it comes to a longer tenure, then gold's returns are lower than that of equity markets. The compounded annual growth rate in gold's price in the last 20 years has been 11.2%, whereas when it comes to the equity market, then Nifty 50 has had a CAGR of 14.9%. Let me translate this into absolute terms so you get even more clarity. Let's assume that 20 years ago you had invested 1 lakh rupees each in both gold and Nifty 50. Now after 20 years, the 11.2% CAGR returns in gold would have taken your corpus's value to rupees 8,35,000. On the other hand, post 14.9% CAGR returns, the amount invested in Nifty 50 would have become 16,08,000 rupees in the same number of years. This amount is roughly double than that of the corpus's value in gold. Undeniably, the additional 3.7% CAGR returns make Nifty 50 the clear winner in the long term. So from a financial standpoint, investing in gold cannot become an alternative to investing in the equity markets. Now the problem is that when economic uncertainties and geopolitical tensions bring a major correction in the stock market, then in most cases, investors do not get enough time to pull out their money from the markets. So how can one approach towards managing this risk with the help of gold? The only feasible way that I see is to strike a balance in one's portfolio. What I mean is that whatever be the stance of the market, one can choose to invest 10 to 20% of their portfolio in gold, which would then act as a hedge against hyperinflation, increased interest rates, and even geopolitical tensions such as wars. Now let's say an investor decides to invest 15% of his portfolio in gold. Then the next question that arises is, what would be the best way to invest in gold? Would buying gold jewelry be a good option, or is there a better way? Well, in my opinion, buying gold jewelry may not be the best option available. The reason is that the making charges on gold jewelry can range from 5% to as high as 20%. And at the time of selling this gold jewelry, these making charges cannot be recouped. Additionally, one would also have to pay 20% long-term capital gains tax, which would reduce your returns even further. So now the question is, what's the better alternative? The answer is sovereign gold bonds. SGBs are government securities that are denominated in grams of gold. They are issued by the Reserve Bank of India on behalf of Government of India. Investors can easily buy these gold bonds from banks or designated post offices. By investing in SGBs, an investor not only enjoys the capital gains from increase in the gold's price, but also enjoys a 2.5% interest that is paid out to the holder in his or her bank account semi-annually, that is every 6 months. The lock-in period for SGBs is 8 years, but investors also get an option to exit early from the scheme by redeeming their SGBs in the 5th, 6th and 7th year on the date of the interest payment. Now some of you might start thinking that since redemption is possible only after the 5th year, the money invested in SGBs will get blocked for a period of 5 years. Well, to give you a relief, that is not the case. When applying for SGBs, there is an option to hold these securities in a dematerialized form in a demat account. What this does for an investor is that it opens the possibility of selling one's SGB holdings in the secondary market. With respect to the risk, the default risk is nil because SGBs are government backed. But yes, an investor does hold the risk of price decline in gold. Also, currently, the volume of SGB trading is quite low in India, so it is possible that it might take you some time to liquidate your bonds. Investing in SGBs is mostly favorable for people who will not touch their investments for a period of 5 years. Now, coming to the taxation aspect, the 2.5% interest that is received by an investor is taxed as per the tax slab they fall in. And as per section 193(4) of the Income Tax Act, the interest received is not subject to TDS. If we talk about capital gains, then the redemption value is fully exempt from income tax if the SGBs are held till maturity, that is 8 years. This is what makes SGBs really attractive. Also, if one exercises early redemption post 5 years, then also the capital gains are exempted from tax. However, one should note that selling one's SGB holdings through a stockbroker is considered as transfer of bonds, and so you will have to pay tax on it. Redemption happens only when you hand over your SGB holdings to the issuing authority, that is RBI. This is the reason why stockbrokers such as Zerodha ask you to file the redemption form at least 10 working days prior to the coupon payment date so that the redemption process can be completed smoothly. Now, the treatment of capital gains is different when you sell the SGBs before 5 years. If the SGBs are sold within 3 years of purchase, then it is considered as short-term capital gains, and so it will be taxed as per your income tax slab. On the other hand, if you sell your SGBs between 3 and 5 years, then the capital gains are taxed at either 10% without indexation benefits or at 20% with indexation benefits. For those of you who don't know, indexation benefit means when the capital gains are calculated, the purchase price of the bond is adjusted by the inflation rate, the effect of which is that the overall taxable gain is reduced. The investor can choose between these two methods in order to pay the lower tax amount. So to conclude, over the long term, investing in gold is not an alternative to investing in the stock market. Investing in gold does make a lot of sense when there are chances of a major economic crisis or the occurrence of geopolitical tensions, which would then bring a major correction in the stock market. And lastly, sovereign gold bonds are a great way to invest in gold without worrying about theft, payment default, or the high making charges that occur in case of gold jewelry. Do consult with your financial advisor before making any investment decision. I hope this video gave you valuable insights and you learned something new today. Thank you so much for watching. Like the video, hit that subscribe button, and stay tuned for my next video.